Amerant Bancorp, ticker AMTB, second quarter 2026. So Q2 EPS came in at 53 cents.
Which is a really solid beat compared to the 44 cents we saw in Q1.
Yeah, up nicely. Net income hit $21.0 million, and net interest income landed at $82.6 million for the quarter.
And looking ahead, the guidance is pretty aggressive. Management is projecting total loans to reach $7.3 billion and deposits to hit $9.1 billion by Q4.
Right, and they expect the net interest margin, the NIM, to basically hold flat at around 3.50% for the rest of the year.
But you know what really stood out to me is how management is signaling their own view on the valuation right now.
Oh, the buybacks. Yeah, they repurchased 690,000 shares this quarter.
Exactly. At a weighted average price of $23.29. That is exactly 1.02 times tangible book value. I mean, they're effectively buying their own stock at par with its underlying asset value.
Yeah, you pair that aggressive buyback with the 9-cent quarterly dividend they just declared, and, well, you're looking at a management team signaling intense internal confidence, right?
Absolutely. They feel very good about their near-term capital position.
But on this deep dive, we aren't just going to recite a Q2 earnings report. We've got a specific mission today.
Right. We need to look under the hood.
Yeah, we're unpacking how one regional bank is pulling off this massive liability restructuring. I mean, they're finding deposits for less than 1% in a high-rate environment.
Which is almost unheard of right now.
It really is. And we're going to question whether their reliance on international cash is, a brilliant permanent moat or maybe a geopolitical compliance headache waiting to happen.
Because to understand why Amerant is succeeding right now, you really have to look past that top-line growth.
Right. Total assets grew 3.9% to $10.3 billion, which is fine. But the real story is how they're funding those assets.
Yeah, the liability side of their balance sheet is just undergoing this fascinating transformation. I mean, every bank right now is fighting this brutal war for deposits.
Oh, for sure. Customers know they can just park your cash in a money market fund and get 5%.
Exactly. So keeping them in a standard checking or savings account is incredibly expensive for these banks.
Yet Amerant somehow saw a 9.4% quarter-over-quarter surge in core deposits,
Bringing that total up to $6.4 billion.
A near 10% jump in a single quarter for core deposits is just a total outlier in this macro environment.
It is. But it's the composition of those liabilities that really shows you the strategy they're executing.
Right, because while they were bringing in all that core deposit cash, they were deliberately shedding the expensive stuff.
Yeah, they dumped the high-cost funding. Broker deposits fell to $498.2 million.
And advances from the Federal Home Loan Bank, the FHLB, those declined 4% down to $702.6 million.
Let's unpack the mechanics of that swap for a second, because it really is the engine driving this entire quarter.
Yeah, go for it.
So when a bank doesn't have enough organic customer deposits to fund their loans, they have to buy liquidity on the wholesale market.
Right, which means issuing broker deposits or borrowing from the FHLB.
Exactly. But wholesale money is institutional, it's highly rate sensitive, and honestly, it's very expensive.
Right. So by replacing that institutional wholesale funding with organic core deposits, Amerant is fundamentally lowering their cost of goods sold.
That's a great way to put it.
Yeah.
And their cost of goods sold, meaning the interest they pay on deposits, reveals this massive structural advantage.
Yeah, because their domestic deposits are currently costing them 2.93%, which, in a world where the Fed funds rate has been elevated, 2.93% is a solid competitive rate.
It is. But then you look at their international deposits, those are costing them an unbelievably low 0.99%.
Wait, less than 1%?
Less than 1%. Finding funding that cheap right now is basically the holy grail for a regional bank. It brings their overall cost of funds down to 2.38%.
That is just wild, and that dynamic allows them to pile up cash without completely crushing their margin.
Which they did. Their cash and cash equivalents jumped to nearly 60% this quarter to $301.1 million.
Okay, I really want to dig into the why behind that 0.99% figure, because for a retail investor listening to this, it kind of defies basic financial logic.
It does sound crazy at first glance.
Right. Like, why would any depositor accept less than 1% yield when risk-free U.S. Treasuries are yielding so much more?
Well, it comes down to what those international clients, particularly the ones from Latin America, are actually buying. They aren't buying yield.
They're buying jurisdictional safety.
Exactly. The premium they're paying is for capital preservation. If you're a high net worth individual or a corporation in a Latin American economy, dealing with hyperinflation or currency devaluation.
Or just general political instability.
Right. Your primary goal is getting your capital into the U.S. banking system. You want dollar denomination, and U.S. legal protections.
So you are more than willing to forego a few hundred basis points of yield just for that structural security.
Yeah, and Amerant, being headquartered in South Florida, has built the specific infrastructure to capture that exact capital flight.
But I guess my pushback would be, is that capital flight a permanent moat? I mean, in a modern financial system where wire transfers take seconds, even international clients can just open a U.S. brokerage account and buy a treasury ETF, right?
That's a fair point.
They might not be as rate sensitive as, say, a domestic corporate treasurer who will move $10 million overnight for an extra 0.5%. But ignoring yield entirely feels like it has to be a temporary phenomenon.
Well, it acts as a much stickier buffer than domestic funds, certainly. The friction of moving money across borders, passing through all those stringent U.S. compliance checks.
Right, the KYC and AML stuff.
Yeah, establishing new banking relationships makes these international depositors highly reluctant to chase yield once they have their money safely parked.
That makes sense, but relying on that behavioral friction forever is dangerous. Eventually, even safety-seeking capital realizes it's leaving money on the table.
Which brings us to the operational reality for Amerant. Cheaper funding is a massive advantage, but it's only half the battle.
Right, you have to actually translate those cheap liabilities into operating leverage. And if we look at the margin dynamics this quarter, they are honestly slightly counterintuitive.
Yeah, they are.
Because despite that 0.99% international funding, their overall net interest margin actually ticked down slightly from 3.55% down to 3.52%.
And the average yield on their loans also dropped, going from 6.38% down to 6.22%.
So why is that happening if their funding is so cheap?
It's a direct consequence of the balance sheet mechanics we just talked about. Remember that 60% surge in cash equivalent?
Oh, right, up to $301 million.
Exactly. Cash sitting at the Fed or in short-term instruments just yields less than a long-term commercial real estate loan.
Right, so by intentionally holding more cash and building up liquidity, they are mathematically dragging down their average earning asset yield.
Precisely.
Yeah.
They're sacrificing a bit of top-line margin to maintain a highly liquid defensive posture.
But the crazy thing is, despite the NIM and the loan yield ticking down, the overall profitability metrics actually expanded.
Yeah. Return on assets, ROA, grew to 0.84% from 0.73%.
And a return on equity jumped to 9.23% from 7.63%. So the revenue generation rate is slightly compressed, but they're dropping more money to the bottom line.
And that margin expansion is the bridge to management's core stated goal. They have laid out this very explicit path to 1% ROA target that they intend to hit by Q4 of 2026.
But the gap from 0.84% today to a full 1% in just 6 months, that is significant. And as we noted at the top, management's own guidance expects NIM to stay flat at around 3.50% for the rest of the year.
Which means the revenue side isn't going to do the heavy lifting here.
Right. The revenue engine is cruising at a steady altitude. To get from 0.84 to 1% ROA, Amerant has to rely almost entirely on ruthless operating expense reduction.
And this is where the execution risk for the retail investor becomes glaringly obvious. Let's talk about the efficiency ratio.
Yeah, let's do it. For those tracking bank performance, the efficiency ratio simply measures how much it costs the bank to manufacture $1 of revenue. Right now, it's costing Amerant over 68 cents to make a dollar.
Specifically, a 68.37% efficiency ratio. And management's stated goal is to drive that down to approximately 60%.
Okay, here's where it gets really interesting, though. Getting from 68 cents to 60 cents in 2 quarters requires flawless cost cutting. But the Q2 numbers show the exact opposite trend.
Yeah, non-interest expense actually went up this quarter.
Right. It climbed from $66.9 million in Q1 to $68.9 million in Q2. And it wasn't just like a one-off technology investment. Their full-time equivalent headcount actually increased to 704 employees.
Salaries and employee benefits hit $35.4 million this quarter.
So you have rising headcount and rising compensation costs, but the bank is promising the street that expenses will magically compress in the fourth quarter to hit that 60% target. Are they relying too heavily on a Q4 miracle?
That tension is absolutely the defining hurdle for the stock's near-term performance. If you review management's presentation, they're modeling operating expense reductions to contribute about 0.08% of that climb toward the 1% ROA.
Okay.
And their explicit guidance projects expenses in Q3 to stay stubbornly high in that upper 68 million range before projecting a steep, almost vertical drop down to the 66 to 67 million range in Q4.
Relying on a back half of the year drop to hit profitability targets always makes markets nervous. They're citing the implementation of additional cost-saving initiatives expected to materialize late in the
The
year.
market will definitely be analyzing that Q3 report with a microscope to see if that expense curve actually begins to bend downward.
Because if headcount keeps growing, that 1% ROA target becomes mathematically impossible without some unexpected surge in interest rates.
Right. But cutting operating expenses to hit that 1% ROA only works if unexpected costs don't blow up in their face.
Oof, yeah. And for a bank, the ultimate unexpected cost is a bad loan.
Exactly. If credit quality tanks and they have to start funneling millions into their loan loss reserves, all of that expense cutting is completely neutralized.
So we have to examine how vulnerable their $6.9 billion gross loan book actually is.
And this is arguably where Amerant executed best this quarter. They are aggressively cleaning house.
Yeah, non-performing assets dropped to $186.6 million, but the leading indicators, the loans that are showing stress before they actually default, those saw massive improvements.
Classified loans plummeted 14.7% to $273.1 million.
And special mention loans dropped almost 26% down to $109.8 million.
A 26% drop in special mention loans in a single quarter does not happen organically. Borrowers facing cash flow crunches don't just suddenly find millions of dollars and cure their weaknesses in 90 days.
Right, so how do they do it?
Amerant achieved this through active defensive balance sheet management. They didn't just sit around hoping these stress loans would resolve themselves. They deliberately exited out-of-footprint exposures and actively sold off the loans.
I love this strategy. It's the equivalent of, pruning the dead branches to save the tree, or paying a premium to transfer your fire insurance policy to someone else while you can actively smell smoke in the kitchen.
That is exactly what it is.
They're taking a tactical hit, selling these weaker loans at a discount to distressed debt funds or other buyers, specifically to get the risk off their books before it becomes a total loss.
They take a small known loss today to prevent a catastrophic unknown loss tomorrow. And that tactical sacrifice secures the overall health of the institution.
And you can see the immediate relief that pruning provides to the income statement. Because they offloaded that risk, their provision for credit losses, which is the capital regulators require them to set aside for future bad loans, that fell from $7.8 million down to $4.8 million.
That is a massive release of pressure on the bottom line, and it flows directly into supporting that ROA expansion.
But let's dig into the non-performing loans that they chose to keep, because they still have $171.1 million in NPLs sitting on the balance sheet.
Right, and when a bank holds non-performing assets, the immediate question for the investor is the quality of the collateral backing those bad loans.
Exactly. And of that $171.1 million bucket, $66.5 million is backed by real estate.
Which brings us to the critical metric here, the loan-to-value, or LTV. The weighted average LTV on that $66.5 million in real estate-backed non-performing loans is 63%.
Okay, so just to clarify for the listener, even on the loans where the borrower has completely stopped paying, Amerant basically has a 37% equity cushion in the underlying physical real estate before their principal is impaired.
Right, a 63% LTV provides a highly conservative margin of safety. In the current banking environment, commercial real estate valuations are facing severe downward pressure.
Due to higher capitalization rates and shifting office demand, yeah.
Exactly. But with a 37% buffer, commercial property values would have to absolutely crater before Amerant takes a dollar of loss in a foreclosure scenario.
Now, the remaining $66.7 million of the NPLs are cash flow dependent commercial loans, which they've evaluated for collective reserves. But that real estate equity cushion is a vital metric for downside protection.
It really is. And the outcome of all this defensive maneuvering is a net charge-off ratio that dropped to a microscopic 0.08% for the quarter.
I mean, in the context of regional banking, 0.08% is basically zero. It's concentrated in the commercial segment at 0.05% and consumer at 0.03%.
They took essentially zero charge-offs in commercial real estate this quarter, which is kind of wild given the endless headlines about the collapse of CRE.
It is wild.
Right.
But we have to ask, with the net charge-off ratio dropping that low, is the credit storm officially behind them, or is this just cosmetic balance sheet dressing because they dumped the ugliest loans right before the quarter ended?
Well, it's certainly true that the 0.08% annualized rate is artificially low because of those proactive loan sales. By selling the classified and special mention loans now, they're shrinking the denominator of potential problems.
Right. They're removing future charge-offs from the pipeline.
Exactly. So credit costs will inevitably normalize to a slightly higher historical average. However, It proves that their risk management strategy is highly effective. They recognized out-of-footprint risk, paid the price to eliminate it, and successfully insulated their core portfolio.
Okay, so synthesizing all these moving parts for the investor looking at AMTB, the bull case coming out of Q2 is undeniably compelling.
It really is.
You have a bank generating massive, sticky core deposit growth at over 9% sequentially. You have fundamentally improving credit metrics driven by aggressive portfolio pruning and, highly conservative collateral values.
And you have a management team actively returning capital to shareholders through stock buybacks below tangible book value.
Yeah. All of this is happening while they march toward a 60% efficiency ratio and a 1% ROA.
The thesis is strong, provided they can actually execute on those operating expense reductions in the fourth quarter. The balance sheet itself is positioned with extreme defensiveness, heavily anchored by that incredibly cheap sub 1% international deposit base we analyzed earlier.
But, and there's always a but, there is one specific detail regarding those cheap international deposits in the source material that really demands attention.
Yeah, this is the geopolitical wildcard.
Right. When management discusses strengthening the relationship-first model to support lower-cost deposit growth in international markets, the filing explicitly mentions one country by name.
Venezuela.
Yep. And we need to frame this purely through the lens of financial reality and operational risk, completely separate from the politics. We are just looking at the facts here.
Right. In the banking sector, taking deposits from complex, highly volatile, or heavily sanctioned jurisdictions introduces massive compliance burdens.
The reason a typical U.S. megabank doesn't just scoop up all these 0.99% Venezuelan deposits is because the Know Your Customer KYC and anti-money laundering AML compliance costs are astronomical.
Exactly. Verifying the legitimate source of funds in a chaotic geopolitical environment requires specialized, expensive compliance infrastructure.
It forces you to really weigh the ultimate risk-reward premium. On one side of the ledger, you have funding costs of 0.99% in a 5% interest rate world.
That is an asymmetric superpower for their net interest margin. It completely shields Amerant from the brutal domestic rate wars squeezing every other traditional regional bank. And they've clearly built the specialized compliance apparatus to handle these specific Latin American inflows safely.
Right. But on the other side of the ledger, you are anchoring a significant portion of your liability structure to depositors from a nation with extreme geopolitical volatility.
It's the exact question you have to ask when the financial math looks almost too good to be true.
Is this highly specialized international deposit pipeline a permanent, unassailable moat? Or does it introduce a unique geopolitical risk that a standard U.S. regional bank simply never has to worry about?
It is a fascinating dynamic to mull over as you evaluate risk in the regional banking sector right now.
It really is. Well, that wraps up our deep dive into Amerant Bancorp's second quarter. Make sure you're following the show for daily, no-nonsense earnings coverage just like this. We will see you on the next deep dive.